Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host. I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoan here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Our first topic today is about the recent report identifying Toronto as Canada's epicenter of weakness for home building. This has raised questions about whether the Ford government can still achieve its goal of building 1.5 million new homes by 2031.
Yes, Andy, it's quite concerning. The latest data from the Canada Mortgage and Housing Corporation shows that Ontario is lagging significantly behind in housing starts. From January to July this year, there have been just 33,821 new houses started, which is a 25% drop from the same time last year.
And that's especially troubling when you compare it to other provinces. Quebec, for example, has seen a 38% increase in starts year on year, while the prairies have increased by 24%. Even Atlantic Canada is up 16%. Ontario's performance is really stark in contrast.
The report also highlights that confidence in the housing market is particularly weak in Ontario and British Columbia. In Toronto, for instance, starts on new condos have plummeted, and pre-sales are at their lowest level since 2009. It's a tough market out there.
It seems like the Ontario New Democratic Party is quite critical of the Ford government's handling of the situation. They claim the government has thrown in the towel on housing and aren't doing enough to increase housing starts, shifting the burden onto municipalities.
That's right, Sandy. And Housing Minister Rob Flack has admitted that the outlook is bleak. He mentioned in August that potential new homebuyers have essentially hit the pause button, causing the market to come to a standstill.
The government spokesperson did mention some efforts to accelerate housing development, like investing in infrastructure and giving municipalities the tools they need. But they also cited challenges beyond their control, like global economic uncertainties and supply chain disruptions.
Indeed, they even pointed to external factors like President Trump's tariffs affecting the situation. Yet, despite these efforts and explanations, they didn't confirm if the goal of 1.5 million homes by 2031 is still achievable. It's a bit of a mixed message.
And it seems like the criticism isn't just from the opposition. There's a general sense of frustration among Ontarians who feel the pressure of the housing crisis. Condo construction is in free fall, and rental projects are stalling.
Absolutely, Sandy. Jessica Bell, an Ontario NDP member of provincial parliament, has been quoted saying that Ontarians are paying the price for what she describes as Ford's failures. It's a challenging time for the housing market here in Ontario.
Our next topic revolves around the latest insights from Equifax, which indicate that households in Ontario and British Columbia are facing significant challenges due to rising renewal costs. This is a substantial concern as mortgage growth remains subdued in these areas.
That's right, Sandy. Equifax's report from their second quarter 2025 consumer credit trends call highlights that the Canadian economy is under strain as growth slows and living costs rise. It's becoming increasingly difficult for families to manage these higher expenses.
Rebecca Oakes, Vice President of Advanced Analytics at Equifax Canada, noted that the gross domestic product saw a noticeable decline in the second quarter, both overall and on a per capita basis. She pointed out that while domestic demand has helped cushion the macroeconomic outlook, the labor market is showing signs of weakness.
Yes, Sandy, with over 60,000 jobs lost in August and unemployment rising to 7.1%. According to Statistics Canada, the situation is precarious. Oakes mentioned that this rise in unemployment is a shock factor for credit measures, affecting households' ability to meet higher mortgage payments.
And on the credit side, consumer debt has increased by about 3% year over year, although the growth has slowed. There's a noticeable divide between those with mortgages and those without. Non-mortgage holders have seen debt rise, while mortgage holders have managed to keep increases more contained.
Equifax noted that renewals, not new lending, are driving mortgage activity. Canada's total mortgage balance is around $1.9 trillion, with the average balance at $247,000. Interestingly, first-time buyer activity has edged up slightly, but it's still not enough to signal a recovery.
Swarnima Pandey, Analytics Insights Manager at Equifax Canada, emphasized that renewals have surged by 27% year over year. However, these renewals are resulting in payment shocks for many borrowers who are moving from ultra-low pandemic rates to much higher rates.
And that's a key point, Sandy. Borrowers are seeing substantial increases in their monthly costs, especially those who locked in fixed rates during the pandemic. This is testing household budgets in ways we haven't seen in over a decade.
The risks are particularly concentrated in high-value markets like Ontario and British Columbia, where home prices surged during the pandemic. Equifax reported that the 90-plus day mortgage delinquency rates have risen in these provinces compared to last year.
Kathy Katsouliris, Vice President of Analytical Consulting at Equifax, mentioned that the slowdown in sales activity is compounding the issue. The market is on hold, waiting for either rate relief or improved affordability, leaving lenders and borrowers in a challenging position.
Let's dive into what's making headlines in the Ontario real estate world. The industry is currently grappling with the fallout from the iPro Realty scandal, a situation that's been described as a multi-million-dollar debacle. Reports have emerged about a shortfall of approximately $8 million in the company's trust accounts, which has sent shockwaves throughout the sector.
It's a troubling situation for sure, Sandy. The funds in question, which include real estate commissions and down payments, were reportedly used for operating expenses and payments to investors. This has raised serious questions about brokerage standards and regulatory oversight in Ontario.
The Real Estate Council of Ontario, or RECO, is under scrutiny as well. They initially didn't charge the brokerage after discovering the shortfall, and it wasn't until August, 4 months later, that the trust account was frozen. This has led to criticism about how the situation was handled.
The Ontario Provincial Police have now launched an investigation, which adds another layer of complexity to the issue. And there's a lawsuit from private lenders in Ontario's Superior Court of Justice claiming iPro owes them more than $4 million in loans dating back to at least 2019.
It's not just about the missing funds. This scandal comes on the heels of a 2022 audit by Ontario's Auditor General, which criticized RECO for not being fully effective in protecting consumers in real estate transactions. The audit suggested that RECO needed to step up its game, especially when compared to regulatory practices in British Columbia.
And this is having a ripple effect on the mortgage industry as well. Many mortgage professionals work closely with real estate agents and brokerages, so this scandal underscores the importance of due diligence when choosing who to partner with.
John Lusink, the president and broker of record at Right at Home Realty, emphasized the need for mortgage brokers to be selective in their partnerships. He advises against trying to work with everyone, and instead suggests building solid relationships with well-established and active partners.
Lusink makes a good point. He mentions that experienced mortgage agents should take the time to interview and meet with potential partners to understand how they operate. It's about slowing down and ensuring that partnerships are built on a solid foundation.
Beyond the iPro scandal, there's also a broader concern about education standards in the real estate industry. Lusink noted that since RECO took over agent education from the Ontario Real Estate Association, the process has become easier, which might not be in the best interest of the industry.
That's a significant issue, Sandy. Lusink points out that the education standards haven't adapted to the influx of people entering the field as a sideline, rather than a full-time commitment. He suggests that there might need to be a longer probationary period or something similar to ensure agents are fully prepared.
Let's talk about first-time homebuyer rules in Canada. It's not as straightforward as one might think. Different programs have different definitions, which can make things confusing for buyers. Steve, have you encountered clients who have been caught off guard by these rules?
Absolutely, Sandy. Many people assume that if they've never bought a home in Canada, they're automatically first-time home buyers. But that's not always the case. For instance, if they've owned a home abroad, they might be disqualified from certain benefits here.
Right. And the Ontario Land Transfer Tax Rebate is a prime example. To qualify, you must never have owned a home anywhere in the world, and neither can your spouse or common law partner if you've been together. That's a tough rule for many couples.
It sure is, Sandy. And real estate lawyer Maria Berenbaum points out that you must also be a Canadian citizen or have permanent resident status to qualify. If your status changes, you have a short window to apply for the rebate.
Then there's the RRSP Homebuyers plan, which is more lenient. It has a 4-year look-back rule. If you or your partner haven't lived in a home you owned in the last 4 years, you might still qualify as a first-time buyer again.
That's right. It's a bit of a fresh start clause, and it can be beneficial for those who have been renting after selling a home. It gives them another chance to tap into their RRSP savings for their down payment.
The first home savings account is another option. It combines the benefits of an RRSP and a TFSA, and it has a similar 4-year look-back rule. But there's a catch. You must meet the eligibility criteria when you open the account, not just when you want to use it.
Exactly, Sandy. Timing is crucial with the FHSA. We advise clients to open one early if they think they'll buy a home in the next few years. Even a minimal contribution can start the clock on eligibility.
Comparing these programs, the Ontario Land Transfer Tax Rebate is the strictest. The RRSP Homebuyers Plan and the First Home Savings Account offer more flexibility, especially for those who have been out of the market for a while or have separated from a partner who owned a home.
That's a good point, Sandy. It's important for buyers to know which programs they qualify for. It can make a significant financial difference, especially in high-cost markets like Ontario.
Our advice to listeners is to consult with a mortgage expert early on. They can help navigate these definitions based on personal history and ensure you don't miss out on potential benefits.
And remember, honesty about your ownership history is key. Even an old vacation property can affect your eligibility. It's better to be upfront and avoid any surprises down the line.
Steve, it seems like there's a significant shift happening in how Canadians are approaching their financial relationships. A recent Equifax Canada survey reveals that many Canadians, especially younger ones, are contemplating switching banks and lenders to better meet their credit and mortgage needs.
That's right, Sandy. The survey shows that 56% of mortgage holders are considering refinancing with a different lender when it's time to renew. This indicates a strong desire for better terms and possibly more favorable conditions than their current lenders are offering.
And it's not just about the mortgage holders. The survey highlights that 57% of Canadians under 35 would switch financial institutions if it helped them build and monitor their credit more effectively. That's a significant portion of the younger demographic.
It's interesting to note that only 38% of those aged 35 and older feel the same way. This suggests a generational divide in how Canadians perceive their financial institutions' support for their credit needs. Younger Canadians seem to be more proactive and possibly more willing to explore new options.
Another key point from the survey is that 40% of respondents feel their banks or lenders could do more to support their changing credit needs, like adjusting credit limits or offering new solutions. This indicates a demand for more responsive and tailored financial services.
Indeed, Sandy. The survey also emphasizes that 95% of Canadians see protecting their credit and identity as crucial. This underscores the importance of trust and security in these financial relationships, which might be driving some of the consideration to switch.
And with 79% stating that access to credit is critical for reaching their financial goals, it's clear that Canadians are looking for institutions that can provide not just access, but also support in managing and leveraging their credit effectively.
The survey also notes that nearly 2 in 5 mortgage holders have considered switching lenders in the past year, with a similar number receiving refinancing offers. It seems the pressure of current mortgage conditions is encouraging borrowers to look for better deals.
For newcomers to Canada, the numbers are even higher, with 55% considering switching financial providers. This suggests that newcomers might be feeling underserved by their current banks and are actively seeking alternatives that better meet their needs.
Younger mortgage holders, in particular, are more inclined to explore refinancing options, with 62% planning to look elsewhere at renewal time. This indicates a more dynamic approach to financial management among younger Canadians.
Generational differences also appear in credit needs. While 72% of Canadians aged 35 and older feel they have sufficient access to credit, only 62% of those under 35 agree. This disparity highlights the evolving expectations of younger demographics.
Among newcomers, 84% cite access to credit as essential for meeting their goals, compared to 78% of Canadian-born respondents. This highlights the critical role of credit in helping newcomers establish themselves financially in Canada.
The survey reveals that 19% of Canadians feel they lack sufficient access to the credit and lending products needed to achieve their goals. Clearly, there's room for improvement in how banks and lenders meet these needs.
With fewer than half of respondents believing their current bank or lender is helping them achieve their financial goals, and just over half trusting them to help improve their credit over time, it's no wonder there's consideration of switching. Financial institutions need to address these gaps to retain customers.
It seems clear that the financial landscape is evolving, and Canadians are looking for more from their banks and lenders. The demand for better credit support is driving this trend, and institutions that can adapt may find themselves at an advantage. Our final topic today is the expected move by the Bank of Canada to cut its benchmark rate by 25 basis points next week. The anticipation comes as weak employment data has hardened expectations for a rate reduction. Steve, what are your thoughts on this?
Well, Sandy, Penelope Graham from ratehub.ca has indicated that the central bank now has a compelling reason to deliver this 25-point cut, especially as we've seen a significant drop in employment numbers. The Canadian economy lost 66,000 jobs last month, following a 41,000 drop in July. And with the unemployment rate climbing to 7.1%, it does seem like there's a need for some economic stimulus.
That's right, Steve. The job losses have been particularly harsh in manufacturing, which has shed 58,100 jobs over the past 7 months due to the trade war. Professional, scientific, and technical services also lost 26,000 jobs just last month. Ontario, British Columbia, and Alberta have been hit the hardest, while Quebec's employment has remained stable.
And Penelope Graham also pointed out that tariffs are eroding economic strength, so some stimulus might be necessary in the short term. With the U.S. Federal Reserve also likely to cut rates, the Bank of Canada has a bit more leeway to lower rates without putting too much pressure on the Canadian dollar.
The decision from the Bank of Canada, scheduled for September 17th, will also depend on the latest inflation numbers, which are due the day before. If there's further progress in the headline number or any softening among the core metrics, it could further solidify the case for a rate cut.
That's right, Sandy. Even though Canada's overall inflation is still below the bank's 2% target, the core rate is slightly higher. So, while a rate cut seems likely, the bank won't want to overdo it if core inflation remains elevated. They need to balance providing stimulus with not overheating the economy.
The anticipation of a rate cut has already led to a decrease in bond yields and mortgage rates. Penelope Graham mentioned that the Government of Canada's 5-year bond yield is now in the 2.7% range, which is putting downward pressure on fixed mortgage rates. This is a good time for borrowers to secure a rate hold or pre-approval.
Absolutely, Sandy. Locking in a rate now can protect borrowers' options, as lenders might soon reduce discounts on variable rates, limiting potential savings. And with the spread between fixed and variable rates now just 4 basis points, borrowers have some interesting choices to make.
With mortgage rates easing and home prices remaining stagnant, buyers are seeing improved affordability. Lower mortgage rates and a well-supplied market mean buyers are enjoying some of the best affordability conditions in a while. Further rate cuts could spark increased sales activity in the coming months.
That's a positive outlook, Sandy. According to ratehub.ca's calculator, A homeowner with a 10% down payment on a $672,784 home and a 5-year variable rate of 3.95% would see their monthly payment drop by $84 if the bank implements a 25 basis point cut. That's a savings of $1,008 per year, which is significant.
It's clear that the potential rate cut by the Bank of Canada could have a meaningful impact on affordability and borrowing costs for Canadians. It's an important development to watch in the coming days.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.